In this video, we're going to talk about how to prepare a statement of cash flows using the indirect method. So a statement of cash flows is laid out as follows. So we've got cash flows from operations, and then we've got cash flow from investing activities. That's like selling fixed assets or securities. Cash flow from financing, right? Issuing dividends and so forth, raising money from lenders. And all of these three things here are going to be netted together, and we're going to come up with the change in cash over the period. So if you need a little more detail, I've got videos on each of these. Feel free to check them out, but I'm just going to jump right in and with an example. So let's say that we have the following activities happen for our company. And let's say it's a startup company, it's brand new, and we're just going to build a statement of cash flows from scratch. So we issue $50,000 in common stock. That's how the company's going to be financed. So it's financed 100% with equity. It's got $50,000 in common stock. And then the company goes and buys $20,000 of inventory for cash. Then they sell all that inventory for $45,000. $35,000 of which they receive in cash, $10,000 of which is credit, accounts receivable. Then they incur $15,000 in operating expenses during the year on credit, so accounts payable. They purchase equipment for $8,000, also on credit, and we'll call that accounts payable. Could have been a note or something like that too, a note payable, but in this case we'll say it just goes to accounts payable. And then they pay a cash dividend to the equity holders. They get $500 at some point during the year. So all this is our activity for our new company during the year. We're going to make this simple. We're going to assume there's no taxes, no depreciation on that equipment, no bad debt or uncollectible accounts. I just really want to show you the basics of how we put together a statement of cash flows. So we're going to need a couple of things to make this a little bit easier. We're going to need an income statement. I prepared an income statement so we can have net income, because net income is going to be the first line on our statement of cash flows. So we need an income statement, and I've calculated out from our sales and our cost of goods sold and so forth. From the preceding information, we come out with a net income of $10,000. Then we've got comparative balance sheets, right? So we've got, let's say January 1st is when we started our company, and then December 31st is the end of the year. So we just completed a balance sheet for each point in time. January 1st was easy because we hadn't even started operations yet. So just everything is zero. And then here are our account totals as of December 31st balance sheet. So we can use these numbers and the changes in these balance sheet accounts to prepare our statement of cash flows. So let's get into that. So our statement of cash flows, again, we're going to start with this net income of $10,000. So I'm going to make a little room here. We've got our statement of cash flows. So our net income, we've got our cash flow from operations. Remember we said we start with that, cash flow from operations. And we've got net income of $10,000. So I'm going to put that $10,000 right here. Now we need to make adjustments to net income. Why do we do that? Well, like we talked about in the video with cash flow from operations, net income includes a lot of accruals, things that don't have anything to do with cash, right? So we need to back out some of these effects. For example, what's happening with accounts receivable and what's happening with account payable. So now let's go back to our accounts. So we see that we have an increase in accounts receivable of $10,000. So that's actually, when we are increasing our account receivable, we're not, that increase, we had sales and revenue, that was the corresponding entry with that increased our net income, but it didn't affect cash, right? So this $10,000 was not received in cash. So basically when we have an increase in account receivable, that's going to be a negative number on our statement of cash flows. That's going to be a use of cash. So we'll put negative $10,000 right here. And then, conversely, for our increase in accounts payable, right, we incurred these expenses or purchases of equipment or different things, but we didn't pay out cash yet, right? This is credit that we got. So we basically had an increase of credit here of $23,000 that was extended to us. And so now that is going to be a positive number on our statement of cash flows, $23,000. Okay? Now, what we do is we take these numbers and we net them. We take the net effect here. I'm going to change colors to make it really easy for you to see too. So we're going to have a net effect, net cash provided by operations of $23,000. That's this right here, net cash provided by operations. So that's just the sum total of this right here. Now we calculate our cash flows from investing. So this is sale of fixed assets. In this case, there's a purchase of a fixed asset. It's equipment. So that equipment cost $8,000. So we're going to have a negative cash outflow here, $8,000. That just simply reflects that we paid $8,000 to get equipment. Now you might say, hey, wait a minute. We didn't actually pay cash for that equipment. We put it on credit and it went to accounts payable. And I would say, yes, that's true, but we just accounted for the change in accounts payable here, right? So it all evens out. Okay, so we have this negative $8,000, and now we can come up with, since that's our only transaction for investing activities, net cash used by investing activities. And that's going to be $8,000. And that's, I've got it in parentheses to indicate it's a negative number. And so when you look at this net cash used by investing activities, see we've got used instead of provided with operations. That means that it's negative, right? So this means if we look at all the investing activities, which in this case there was just one investing activity, but we put them all together, we actually used more cash than we generated. But with operations, it's different. We were provided with cash by our operations because it's a positive number. So now we go to our final component. So we had the operations, we have the cash from investing activities, and now cash from financing activities. This is like dealing with lenders, with our equity holders, the people who hold stock in our company. So now we issued stock, and we issued stock of $50,000. So what is that going to be? Well, that's going to be a positive number, right? Because when we issue stock, we're getting cash. We're giving out stock to our shareholders, and we're getting cash in return. And we got $50,000. So that's what we enter, and that's a positive number. Now, we also paid out a dividend to our shareholders. So that's going to be negative, right? Because we paid out this dividend of $500. And so now we can go and calculate the net effect, the net cash of our financing activities. So we've got here $49,500, and that's just the sum of these two, 50,000 minus 500, and this is a positive number. So of course it says net cash provided by financing activities. Okay, so now we can go and say, what is the net increase or decrease in cash that we've had during the period? So we've had an increase. So, and let me just change the colors again to make this crystal clear for you. So we had a net increase of cash of $64,500. Now, how did I compute that? Well, I took the net cash provided by operations, net cash used by investing, net cash provided by financing. We sum those together, and that gives us $64,500. So if somebody said, what happened to cash during the period? We say it went up $64,500. And now, just to really make things clear for somebody who's using our financial statements, we say, what was our beginning cash balance and what was the ending cash balance? Well, this was pretty simple because we were a startup company. We started with zero. And then we ended the year with $64,500.